wanted to provide an update on the mortgage rates. The mortgage industry, like many others, is dealing with more than one problem right now, thanks to the fastest ever economic adjustments that the world has ever seen due to the virus. Let me explain a little bit about the mortgage world. Investors who buy mortgages are planning to make money on interest paid over time. They pay extra upfront for the right to collect that interest. If the loan is paid off earlier than they expect, they either lose money or simply make much less money than planned. So rampant refis make rates go higher or stay even or flat, even as other long-term indicators like the 10-year treasuries plummet to all-time lows. So mortgage rates did make it to their all-time lows a couple weeks back, but not nearly as convincingly as treasuries. And moreover, these low rates resulted in the biggest ever weekly jump in refinance demand. And remember, that's not so great for mortgage valuations and therefore not so great for rates. So couple this with the entire financial market frantically trying to sell everything it can in order to raise cash. And so that means mortgage investors had two big reasons to sell, and when they're selling, rates are rising. This is why mortgage rates jumped higher at the fastest pace in history 2 weeks ago, even as the 10-year treasury yields remained at levels that convinced many savvy buyers that mortgages should be doing much better. And then we hear the news this week that 3.3 million people filed for unemployment. And of course, we all know more on the way. And some in the worst case are going to default on their payments. And then we add to this the disaster relief bill, which encourages millions of Americans affected by the coronavirus-related income disruptions to seek a forbearance on their mortgages. This means no payments for 6 months at a minimum. That, and in of itself, is like a great thing for homeowners, and it provides relief when it's needed most for them. But there are some unintended consequences on the mortgage end. The investors who buy mortgages have a guarantee to receive timely payments. If the homeowner can't pay it, the loan servicer is supposed to. While there is a reason to believe that there's a section in this bill that could and should still cover servicers in need, the absence of any concrete promise has them understandably very cautious. So therefore, in short, the mortgage industry rapidly becomes significantly less profitable, and so there's lower demand among investors, which translates to higher rates. As bondholders better understand their forbearance protections, we expect to see improvements. Of course, there's still lots of volatility, so we'll have to see what happens. As always, I'm committed to helping you through the refinance process and improving your overall financial position. If you're among the small few that haven't yet set a target rate firmly with us already, it's imperative that you do so we can help you take advantage first and quickly when the rates are at the right place in this highly volatile market. So please be safe, practice social distancing to help us all through this faster, and know that I'm here if you need anything at all, not just about the mortgage. Thanks for watching, and do let me know if this was helpful. Sorry it was so long. Bye, Pinky Shah.